In today's video, we're going to talk about US tariffs as well as changes to European fiscal rules. Yesterday and this morning, we've seen volatility within financial markets, and there are two main drivers for that. One is the implementation of tariffs coming from the US, and the second is a change in fiscal spending rules from Germany. So if we focus on the tariffs first in the US, we've seen that the US has placed tariffs on Mexico, Canada and China recently. And we've also seen retaliation tariffs come through from Canada and China back on the US. So this caused some volatility within equity markets, particularly within the US, where those equities were down during the day, but also within Europe, where investors are anticipating that Donald Trump will next look to place tariffs on Europe. Now, this is all part of his America First policy. However, what we would also highlight is that he's threatened to use tariffs on these regions before, particularly on Canada and Mexico, when looking at the tightness of border control. And when both of those regions tightened up, we saw that Donald Trump stepped away from those and he delayed putting those tariffs on. So although tariffs have come on, there's some people speculating within the market that those could quite quickly be changed if they come to some sort of an agreement or deal that Donald Trump would like to make. So we saw volatility within equity markets. We also saw that within fixed income markets. Now, normally we would expect US Treasuries to provide us some sort of protection in those type of volatile moments. However, bond markets don't like tariffs and they don't like Donald Trump's immigration policy, where they feel that both of those will look to rise inflation within the US. So didn't get the protection that we might have expected from US Treasury bonds. If we look at what's happened at the open this morning, and particularly focusing on Europe, that is more related to the fiscal spending rules change that we saw come through yesterday. We've seen that the incoming German Chancellor has looked to change fiscal spending rules, and what this would allow Europe to do is spend more, and particularly Germany, is spend more on their own defence and also look to provide aid to Ukraine, where recently we've saw tensions flare between Ukraine and the US. They're also looking to raise 500 billion euros to spend on infrastructure that would happen over the next 10 years. So this has been seen by equity investors as a positive event, where it's expected to be GDP growth positive. So at the open this morning, European equities are up about 2%. However, similar to the US, fixed income markets are not as positive on that news, where the borrowing is going to have to come from additional debt issuance from Germany, but also the spending is likely to be inflationary. So at the open this morning, we've seen German bond yields move higher by about 20 basis points. So I guess the key message from us here at True Potential is to remain diversified and allowing you to navigate through those short-term market volatility that we're seeing at the moment from the likes of tariffs and the changing policy that we're seeing come through from governments. So please keep an eye on our YouTube channel for further updates throughout this week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.